Welcome back, mindful investors. In this video, we'll talk about the 100% win rate stock option strategy. As always, the video is not clickbaity and there will be real life examples to follow. Feel free to comment along the way if you have any questions. Like and subscribe if you find any value. That'll greatly help the channel. Let's get to it. So what is this winning strategy? The technical name is selling a covered call option. So what is that exactly? Well, you just can't go in randomly and implement this strategy. There are a couple criteria that we need to meet before we can implement it. Number 1, you need to own 100 shares of the stock. Number 2, the strike price should be higher than your cost basis, which means that if it does execute, you're in the money. And then number 3, you just sell this call option. Now we'll go through a real life example. Fiverr. We're gonna look at the ticker Fiverr, FVRR. And I do own 100 shares of them. 100 shares and my cost basis is $116.88. I bought it about 5 months ago. So this meets the first two conditions. Owning 100 shares of the stock and the stock and strike price will be higher than my cost basis. Okay, check. And we'll do this process systematically. For this approach, we have an equation with 7 unknowns. Okay, so number 1, which stock? Okay, number 2, the current stock price and the strike price should be higher than your cost basis. Strike higher than cost. And then we have the option strategy, call or put. Number 4, is it buy or sell? So these are the 4 unknowns you need to consider before implementing the strategy. Alright, so in our case, we have our stock, we have Fiverr, check, Fiverr. And then we have our strike price above our cost basis. So 209 is more than 116, so check. And since we're selling a covered call option, we already decided the third and fourth. So we're selling a call option. There we go. So the first 4 are done. Now we have the next 3. Number 5, the strike price. Number 6, the expiration date. And number 7, the premium. So the option premiums. These 3 factors right here, they work together. So if you want the strike price to go up, then your premiums will be going down. If you want the expiration dates to be closer, then your premiums will also be going down. And if your strike price is lower, then your premium is higher. If your expiration date is further away, then your option premiums will be higher as well. So there's a little triangle relationship there between 5, 6, and 7. Were they all positively correlated? We'll discuss it in depth in a later video. So for my Fiverr instance, I don't really want to get rid of these shares unless there's a huge spike. So I govern this play based on number 7, the option premiums. In my mind, in order to make it worthwhile, I need to collect $100 or more dollars. So we have $100 here, 100 plus. For the expiration date, I usually do it for maybe 3-4 weeks away. We'll see what the option chain gives us. So we have a range here, 3 to 4 weeks. And the strike price for these volatile stocks, I project to be 20+% away. So $210 plus 20%, that's about $250 plus. Okay, so that's $250 plus. Okay, now is the fun part. We go shopping. Okay, we click on options, a month away, so let's say January 15th of 2021. And then we have calls. Whew. Wow, this stock is very volatile. So I'm gonna play it really conservative. You see, even at a strike price of $300 for the next month, I'm getting more than $100. I'm getting more than $1 of premium. So I'm being extra safe here because I plan to hold Fiverr for at least the medium term of a couple years. And I just want to collect some premiums in between. All right. As we can see here, the bid and ask is about 35 cents differential. So I'll just place something right in the middle. I want to execute it. I don't really mind the extra $10, $15, $20. I just want to execute it and get it over with. So I'm gonna place it at 1.5 for the day preview. So the amount I'll get is $150. The commission is $1. So the total would be about $149. I'm happy with that. So we'll submit the sell. Let's see, order filled, yay. So we sold this contract at $1.50, multiply that by 100, I'm collecting $150. If the stock doesn't hit $300 over the next month, so after I establish a position, there are 3 different outcomes. If the stock shoots over our strike price of $300, then I have to sell my shares. So there are 3 scenarios. If Fiverr is greater than 300 by Jan 21, then what happens? Then I have to sell my shares. I have to sell my shares at $300. So what I'll profit is 300 minus my cost basis of 117 times 100 shares equals 18,300. Okay? And if Fiverr is below by Jan 21st, 21, we collect the $150 clear and free. And looking at the share price, we have a 6-month run up from $60 all the way to $208. And what my play is that we see the all-time high 52-week range is at $211. And I'm saying that within the next month, it wouldn't just go skyrocket. It wouldn't just skyrocket to a $300. So that essentially is a 50% gain in 1 month. And if it doesn't happen, in my mind, there is 99% of the time it wouldn't happen. But if it does happen, then I have to sell my shares at 300 and capitalize on the gains, which is the first win. But if it doesn't break the 300, we collect the $150 outright. So that's the second win. So there is a win-win relationship. So if you listen all the way to this point, what is the downside of implementing this strategy? There's always a downside. There isn't a 100% bulletproof way to do anything in the stock market. But what is the downside? The downside is that if the stock over the next month goes to $1,000, then you miss out on all these differential gains of $700 above your $300 strike price. 700 times 100 is $70,000. You miss out on the $70,000 opportunity. But how likely is that? You need to ask yourself that. How likely is it that this stock currently valued at $200 shooting to $1,000 over the next month? I know anything is possible, but how likely? This is the power of selling the covered call option. We always get the win-win outcome. It may not be the max profit play, but to me, if I can consistently win, I'll be happy. So that concludes this strategy. What do you think about it? Will you try to implement it? Do you have any questions? Let me know in the comment section down below. As I mentioned before, I'm making these option videos every single day for the month of December, so I'll try my best to address your questions. Thanks for watching, and I'll see you in the next one.